to continue on the thought of throughput, but also keeping in mind the quality of care, of course we want to get patients through our facility in the quickest manner we can. However, we also want to make sure that they don't come back in. And one of the things that we're looking for is that accountable care organization where a patient goes through our facility, they're discharged with the appropriate discharge information, that the follow-up appointments that they might have at clinics and what have you will lead to a quality of care and quality of service that we've provided so that they don't end up back in our facility. If we rush them through too quickly and they end up readmitted within, say, 30 days, then typically Medicare, Medicaid, government reimbursement will not reimburse us for that second stay. So we want to make sure that the patient gets through our facility and gets the care that they need that's required for whatever condition or comorbidities that they have, but also that they're not coming back anytime soon. As we previously have mentioned, 2/3 to 3/4 of a hospital's revenue comes from CMS, Medicaid, government entities. So we want to make sure that we're complying with the requirements of CMS as well as getting our patients out. Additionally, we're looking at data from our patients as well as the diagnosis for these patients, the comorbidities, because there's an impact on durable medical equipment. It's important that we keep mind of the DME because DME typically has a service life where it can be in service for a certain number of months before it needs to be reconditioned, or a battery needs to be changed, or it needs to be tested to ensure that it's operating correctly. Of course, DME on the floor sometimes comes back down so that it needs to be fixed for whatever reason. There's also incidences of maybe, for example, bladder scanners where one floor tends to hoard the bladder scanners because they can never find them, which also impacts the rest of the hospital. So we need to know where all of our DME equipment is at all times, as well as what the service life is for each of those pieces of medical devices. Today, some of the DME actually may come with an RFID chip or some other way that you can track that. Because keep in mind that when we're looking at durable medical equipment, whether it be beds or bladder scanners or what have you, these are all assets that must be maintained, and they're capital expenses. So they need to be budgeted for as well. Going back to the revenue cycle management of it, it's very important for us to recognize and understand that a hospital is a business. And every business has a balance sheet and a profit and loss statement. So with the balance sheet, we're looking at assets, whether it be plant, people, equipment. They're looking at the different areas around their liabilities, whether it be payroll or that they have contracts for information systems, for example. And of course, that shareholder equity at the end, that balances out with the liabilities to equal whatever the assets are. Assets, of course, are cash plus, any durable things or things that are material. But there's also goodwill that's included or can be included in assets as well. When we go to the profit and loss side of it, what we're looking for, or income statement, what we're looking for is the money coming in versus the money going out and what's left over. Now, those two financials for corporations are utilized to actually do their tax return. So you take the profit and loss, you take the balance sheet, and those two financials are what is utilized to actually put together the tax return that's submitted to the IRS, or the tax return that is submitted for informational purposes to the IRS. Hospitals and healthcare organizations have to work with insurance companies. And insurance companies, typically you will agree to a contract, whether it be a fee schedule or whatever, but you have a master service agreement for a set period of time that a insurance company agrees to reimburse a hospital or to pay a hospital for certain procedures and certain events and things like that. When we're negotiating those contracts with the insurance companies, of course, the insurance company wants to get pay the least amount that they can because they're a business. Insurance companies have shareholders and they have to show profit. But hospitals also have to make sure that they're getting reimbursed appropriately so that they can also maintain a profit. If an insurance company and a hospital cannot see eye to eye and cannot come to an agreement, then that hospital simply won't accept that insurance. The impact for the hospital is the fact that it may have less patients coming in because the patients who are under that insurance can no longer come to that hospital unless they choose to, but then of course they'd be paying out of pocket, which is not desirable. On the flip side of that, if the insurance that you have is not accepted at enough places and your choices are narrowed down, eventually, regardless of cost of the premium, you may switch to another insurance company. Or if you're working and your work provides you insurance and has negotiated that, and you find that your work insurance no longer is accepted at most of the hospitals or providers that you're looking for, then that business may end up having to negotiate with a different insurance company because that insurance company simply doesn't meet the needs of its employees. So it's a very complex and delicate balance between making sure that everybody makes a profit, that everybody has the quality of services that they need, and that us, people, who are actually getting those services, have enough of a choice and enough of a say in who we want to go see and where we want to go get procedures done so that it all works.